Hey, what's up everyone? Praful here. Welcome back. Thanks for joining in. Today is the 2nd of March, the first expiry of this month, and it happens to be the Nifty expiry. And we opened with terrible premiums. The straddle, the 18450 straddle, when we opened was trading at somewhere around 80 bucks. And right after we opened, it tried to hold for 5 minutes. And after that, it suddenly started tanking. And we made a move of almost 100 points, 120 points with the straddle pricing in almost 80 points. So there was a significant IV and gamma spike on the puts. So when I started off with 4,000 quantity, and with every IV and gamma spike, that kind of presented me an opportunity to add the size. And when the markets were about to give this breakout, at which point I felt that the calls are cheap and the puts would not compensate, so I kind of de-risked my position to further off strikes. And if you look at this, my majority of the strikes are almost like a dead trade, which is 17,500 call and a 17,250 put. And some of the positions are, some of the quantities are at 17,450 and 17,300. So with the current premiums, the market is expected to behave the way it behaved yesterday, because yesterday it looked like the volatility was just in the first 15 minutes, right? After once the market broke 17,400, the entire day it was just slowly grinding up for a 50-60 points. So the same thing is expected today as well, and that's the reason the premiums, and that's the exact same thing the premiums are indicating. And I'd also be working with the same view that this low, the low that has been formed here, shouldn't be breached. So if the low gets breached, then it will open up a lot of gamma on the put side. But my view is that this should hold. So that's what the positioning is. And at the same time, even if the market moves up, the call should not actually gain any value. So that's why my calls slightly have some credit in them. If you look at this, there is a good amount of skew. Look at this. The 100 point or 90 point away call is trading at 4, and a 100 point away put is trading at 2.7. So at this point, I would not say the calls are expensive. The calls are definitely cheap, but the puts are even cheaper. All right, the puts are super cheap, and if at all the market breaks any range, it's gonna only expand the premiums and not lead to premium contraction, is the idea that I'm working with. So if at all any swing breaks, I try to exit before the swing breaks. But if I'm not able to manage my exits before the swing breaches, then I'll take some additional credit, and also I'll add on to the size. If you look at this, my size is just 60-70%, right? Like 12,000 quantity rehta hai, but I'm trading currently with only 8,000 quantity each side. So I still have another 30% size to add, but not at this point, because I'm already up close to like 0.5%. So at this point, even if I collect whatever the market has to offer here, I'd probably end at a decent like 0.8, 0.9%, which is quite decent for me, and I don't even want to gun for anything more. So at this point, taking additional risk is out of the question here, and the size will be only added if I see a very significant IV spike. But looking at the markets and looking at the price action, I'm not seeing any sort of a gamma spike prior to 130. So देखेंगे क्या होता है. So all right, time is 1:30. Pretty mum markets, right? The entire day the markets have been within a small range of 17,400 and 17,350. So 50 point के range में ही मतलब आया है market, and sellers would have been making money and buyers would have been pulling their hair out. But nonetheless, my mark to market is at 71,000, and the sizing have slightly increased. My quantities are now at 10,000 quantity, but majority of my size is on like penny options, 1 rupee 60 paise and 1 rupee 60 paise, and some 30% of my size is on 17,300, 17,400. Yes, this can be a very easy situation to manage even with this, but 17,400 call option can be a little bit of a threat, especially post 2 o'clock. Suddenly a 30-40 point movement aa jata hai, so this can immediately spike to 15, 16, 17. So I don't want that risk, especially when the implied vol is very low. See, we are vol traders, right? Like we are short vol traders. So we are shorting the volatility. For that, you need higher implied volatility. Realized volatility क्या होगा वो हमको पता नहीं है. Correct? Realized volatility can be higher, can be lower, doesn't matter. But we need some decent premiums to short. But when premiums are not that great to begin with, I'm not the one to take additional risk. So I'll if the markets start heading down, probably I'll start shifting some 450 calls to 400, and at around 9 or 10 rupees, I'll take the 17,300 puts away. So that's about it. The market is about to break the day's low. If the day's low gets broken, probably it might, मेरे हिसाब से, यहाँ पे थोड़ा नीचे जाके मार्केट वापस एक स्पाइक मारने वाला है. It's just to scare the put writers. So if that happens, probably these 1,700 puts might go up to 10, and from there they can head back. So I'm working with that idea. So let's see क्या होगा यहाँ पे. If day low is getting breached, I have to take some corrective action. Alright guys, time is 3:14, 14 minutes into the averaging, and the markets after breaking the day low. So as I was expecting, I expected that this low shouldn't have been taken out, but it got taken out with a very strong candle, and after that we saw a follow through as well, and then we saw a bounce. We saw a demand at 17,300 levels, and from there the markets tested 17,350 levels and again fell to 17,310 levels. So there was quite a bit of volatility between 2:30 and 3 o'clock, where like I had to jump around between strikes managing my risk, but that didn't lose me quite a bit. But yes, of course it took away some in the form of delta costs, but nonetheless the markets are expiring exactly between 17,350 and 17,300, and I was not trading. I had no positions between 2:45 and 3 o'clock. That's mainly because 17,350 calls as well as 17,300 puts were quite cheap, and they were not to my liking, because कोई भी option immediately triple हो सकता था, and if we keep jumping between the strikes, probably it would just eat into the already existing mark to market. So that's why I completely closed my positions, and once 3 o'clock के move होने के बाद, then I slowly started entering the positions, and I had a mild directional bet. I had shorted the 17,350 put option at somewhere around 21 rupees. You can see here 21 rupees पे मुझे मैंने short किया just 1,000 quantities, and it was like a bodyguard trade for protecting the mark to market on 17,350 calls. अगर 17,350 calls in case spike हो जाता, so this would have acted as a bodyguard kind of a thing. But that didn't work out. Like I had to square it off at 727 rupees. Currently it's trading at 26.3 or something, but that's okay. It was not meant to generate any money for me. It was just meant to protect me from the spiking 17,350 calls. Mark to market is somewhere around 1.2 lakhs, and the funds used are around 1.1 lakhs. So I had a lot of funds left, but I didn't want to go aggressive today because of the kind of premiums that were available for me to trade from the short wall side. So all that said and done, had a decent expiry, almost like 1% on the overall capital, and can't expect more, guys. Like can't expect more in a market like this, because as an option seller, whenever the premiums are extremely low, you always trade from a point of fear, right? When you are trading from a point of fear, there will be some unforced errors that the markets will force you to make. So in such situations, whatever risk averse returns that I'm going to get, I'm going to enjoy that. I'm not going to complain. And let me know in the comment section how your expiry went, and I'll see you guys in my next video. Next video मैं weekend पे या कल ही मतलब मैं video बनाने वाला हूँ regarding the change in the market timings. All right. I hope you guys had a good expiry and have a great weekend. Take care. Bye bye.